Okay, good morning everyone. Welcome to this live intraday strategy webinar on FOMC Wednesday. Today is March 15th. We just got the release of CPI numbers in the United States, slightly stronger than expected on the month-on-month, year-on-year coming in right in line with expectations. Not going to be anything major ahead of obviously today's major interest rate decision. Retail sales figures also largely in line with expectations, even a beat here on XAuto month-on-month. With that noise out of the way, looking at the day ahead of us, it's going to be a big day. Obviously, it's not your run-of-the-mill rate decision. We do get those quarterly projections, the new updated interest rate dot plot. They will have some more color on that today, guys, as they release their new format, quote-unquote, trying to increase transparency to the market. So we'll see what kind of details they offer today. We'll go over what we're looking for in the projections as far as trade setups are going to concerned. On the menu for today, my friends, we've got the DXY, obviously, Euro dollar, Sterling dollar, Aussie dollar, dollar yen, dollar CAD, and Kiwi. We'll go through all the dollar crosses as well as the commodity block, gold, silver, copper, and I do want to take a look at the SPX. I'm not sure who asked about that yesterday. I didn't get a chance to cover it before the end of the webinar, so we'll definitely take a look at what risk assets are doing heading into the release. If you have any other questions or anything to add to that list, as always, feel free to throw them on the message board, guys. Okay. With that said, let's jump right in. Okay, so relative performance. Dollar is actually weaker against all its major counterparts heading into the release. It kind of sets up for the ideal scenario that me and Jamie are looking for to see one last gasp of strength in the dollar as they raise interest rates, maybe come out a little bit more hawkish than expected, unless market shifts expectations from 2 to 3 or 4 hikes. I still am looking for a blow-off in the index. Now, again, not a carte blanche against all the dollar crosses, but certainly the broader theme that we're looking for and what we're looking for relative in the Dixie specifically, which we'll go over in a minute. Before we jump into the charts, I do want to take a minute just to go over what we're looking for from the Fed. So here's what the last interest rate dot plot looked like. I just wanted to highlight the median 2017 estimate left us at a 1.25 to 1.5% estimate for where interest rates would settle at the end of 2017. This is where we're focused on as far as how many hikes we get this year. Okay, obviously, you know, if they hike 25 today, that puts us where we'll be at, and then plus that, you're going to look at whether we'll get to 1.25 or 1.5. That's what the market's trying to really adjust. The terminal estimate, or longer running, sometimes it's called, this will tell us the glide path, the pace of interest rate hikes moving forward, whether they're going to be more aggressive, and we should see more of those in 2017, 2018 span, or whether they're bringing down. Remember, this was brought down last quarter, the median estimate, which means the longer term terminal where rates will settle at in the longer run was lowered, which means, again, a more gradual path of interest rate hikes. So that's really kind of the highlight of what the markets will be focused on as far as the dot plot, is where these median estimates, specifically for 2017, and the terminal rate. As far as the quarterly projections as they pertain to growth, unemployment, inflation, keep in mind that last quarter we also saw them upwardly revise those estimates for 2017 from 2% in September. In December, kicked up to 2.1% on growth. Unemployment even lowered from 4.6 to 4.5. That's the natural rate of unemployment, central tendency. Okay, so we're basically there right now. You can argue all you want about the broader labor force participation rate, but as far as the headline unemployment rate is concerned, we're basically at the natural rate, or we're heading there now. PCE inflation still 1.9%. That's going to, if we see that uptick to 2% specifically, that would suggest that the Fed sees inflation starting to pick up. And remember, core PCE, the personal consumption expenditure, really the Fed's preferred gauge of inflation. That's been sticky at 1.8 for a long time. So again, if you see an upward revision there for 2017 to 1.9, or even the 2% target, which is the Fed's main target on core inflation, then again that would suggest the Fed sees inflation starting to pick up more aggressively and would suggest a more aggressive interest rate hike glide path. So that's what we're looking for. I hope I didn't throw too much at you heading into the FOMC. It's going to be an exciting release. I'll try to keep you updated on SB Squawk and MB Forex as much as I can. Let the dust settle. Again, the game plan, or the, I don't want to say the game plan, but the ideal favorite scenario is markets come into this, they see a little bit more of a hawkish outlook. Fed says, look, you know, things are getting better, the economy's picking up steam, as long as growth policies accommodate, blah, 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 blah. There is risk from Europe. Obviously, we'll see if anything, you know, surmounts as far as commentary on that front. And if they come out a little bit more cautious, you know, that's going to be something that's very, very hairy for the dollar. More so than not, they're going to come out swinging, saying, we got some room for hikes this year. Here's 25 basis points to get us started. What does that mean from a trading standpoint for us? By the way, here's the link, guys. I provided you the link there. Is that link dead? I thought I fixed it. There it is. So here's the link here. It's in the report, but just in case, send it to all right now. It's in the chat box. If you have a minute afterwards, please update Nat Gas after yesterday's drop. Sure. Nat Gas. Let me add that. Gotcha. So guys, this is the link where you'll see the meeting show up. Just click on that link that's in the report right there for the Fed projections at the release, and you'll see right here for the March projection, you're going to be looking for the projections material. Okay, you'll see a link that says projections material PDF come up right here on the right. And that'll be the one that'll have the dot plot as well as the projections that we were looking at here. Any questions on the FOMC? What should we be looking for in the commentary? Again, she's going to come out and just give her batch commentary that's written already, her prepared statements, okay, at 2 o'clock, or at 2:30 the presser starts, but at 2 o'clock is the actual release, and then we'll see the commentary. Really, there's a question and answer period at the end of the commentary, and that's where you're going to see a little bit more of a tell on where the committee sits, whether they're a little bit more hawkish, whether they're leaning towards 3 or 4 hikes, and what specific metrics, if any, they are waiting for before being able to adjust policy further. Okay, let's jump into the charts. Before we do, here's a look at where the Dixie stands. I didn't put an update yesterday. It's the same exact levels we've been looking at since the start of the week. Here's sort of the slope we were working with earlier in the week on the DXY. I want to add something new. And here's what I was looking at right before the webinar. So these are the levels that we sort of started the week on. Again, looking for that rebound, staying bearish sub 101.76. We got a little bit of an overshoot here into the 618, 101.78, a couple of pips higher. Okay, a little bit higher than we wanted, but we got that stretch there. Upper parallel still holding. There's a new slope I was looking at from here that looks like it could be in play. Bear with me, I know this is messy. But the only reason I add this is watch my cursor. You see this slope here? If I take that to the lows, it ends up being the exact low that we caught here and the exact low that we caught here. So I'm actually really liking using this slope more so. So I'm going to go ahead and scratch this at this point, clean this chart up a bit. Still highlights that same 101.76 region. Bear with me one sec, guys. There we go. There we go. Highlight that slope. Boom. Okay, and that's sort of what we'll be walking into FOMC with. So again, the daily chart, where we are, coming up on the underbelly of this slope pattern right here that we've been following, basic slope support off the lows from last year. We've been working on this huge region between 101.80 and 102 for quite some time. That still is sort of the main key region on a broader scale for the index. Near term, that 101.76 level that we just looked at, 101.78 region, again, former highs from back here in February, 618 retracement of the near-term decline, former slope support, now resistance, all up here. Still going to call that 102 level terminal. Okay, break above this is really what would shift the focus back to the upside on resumption. Now, heading into the FOMC, the game plan, or what I would love to see, is strength or fading strength on another spike higher. So if we push through, or even if we scratch 101.78 again, I want to see if we can get some exhaustion. The initial reaction might be quick, but that's sort of the game plan, is staying bearish within the confines of this new slope. And the upper bounds of this new slope is right back up at that 102 barrier, same region. Okay, in fact, if you copy it here, it just gets really messy, but if you copy it here, you can see it's literally right at that same reference point. So long story short, I really want to see where today settles, sub 102. The risk remains lower in the index. Obviously, your support targets haven't changed. You got 101, which is the low opening range low for the week at this point, slope support, median line, and then we'll look for that 175 level, basic 50%. A 100% extension respecting this high gives you 100 spot 55 today. Okay, I don't want to stress this, and again, if we make a new high, this is null and void, but as it stands right now, respecting the overnight high, that would be a 2 equal legs down. So as far as the levels are concerned, very, very clean. I want to stay broadly looking lower while within this new formation that we just added, and that entails basically keeping your bearish invalidation level up at 102, really looking for a break sub 101 to validate a more aggressive reversal here in the greenback. Questions on the Dixie? It's very similar to an upside down chart of the euro dollar. As we always say, it's about 60% euro in the DXY, so always keep that in mind. But again, nonetheless, a good thing to keep an eye on, especially if you're heading into U.S. event risk. So watch that 101.78 near term, 102 terminal. Again, key support still down at 101. Keep in mind this whole time, guys, we've just been pivoting around the monthly open. Here's a closer look at the daily chart. This is the monthly open right here. So let's see if we can't get that sort of range break for the month to get this validated. Okay, going once, going twice. Let's move on to euro dollar. That'll be number 2. Here's what euro looks like on the daily chart. So yesterday we were highlighting a near-term support that we were coming off of. You're seeing some rebound off that now. I'm mindful of chasing this higher from here. You guys all know that we started the week looking lower, ultimately looking for that buy signal. I don't know if this decline kind of wraps it up. I think you kind of want to look for a possible another spike down, which would match with another spike higher in the dollar before turning around. But either way, here's what the near-term chart looks like, and this is kind of the focal support zone right now heading into the FOMC. Just as on the DXY, just as 101.76 is resistance near term, 106.05 here is near term support for the euro. On a downside break, again, possible another entry target near 105.80. Monthly open, 618 retracement, former slope support, resistance, support again. All of that's sort of down here. So if we get one more spike, bullish invalidations all the way at 105.25. That's the only thing that would shift me looking short from here on the euro. Other than that, this is actually a 618 line, okay, of the pitchfork, of the ascent off the lows. Some modified pitchfork, a modified shift for that matter, and the 618 has been a pretty decent pivot. Support, resistance, support. So you could see another scenario where you get a little near-term break here, kind of spills a little bit lower. I don't know if you get down into 105.25. That might be aggressive, last week's low. But based on where we are in the slope, catching support, resistance, just ahead of resistance, I'm basically broadly looking for an entry level on the long side with one last low there. If we take off through 106.60, I think you're on the way to 107, 107.20 as your initial target. 107.60 is a bigger target. And then basically, there's really not much on tap till 108 beyond that. But this is what the 120 minute looks like. And here's what Euro looked like yesterday. Okay, so we actually did find some support right at that level. There's the rebound that we're seeing right now. Again, the real impetus is on getting through that 106.60 region to get this thing back on the upslope for the Euro. Any questions on Euro dollar before we move off? Very similar to picture to what you're looking at with the DXY. Okay, number 3 will be sterling. Here's what cable looks like heading into the release. Really emphasizing that range, just going back and forth. Ping pong, 122.60, 121.40 is what we highlighted earlier in the week. Got an overshoot, or I guess a breakthrough, a false break of the downside there before recovery. Overnight trade, again, failing just ahead of 22.60. Look, it's sterling. It's going to do a sterling thing here, I think. I still like the exhaustion trade for a long on either a move into 120.44 on sort of a washout to the downside, or a topside break of 22.60 and a test and a retest of support, and that's where you would look to get in again for the long move. So here's what I said yesterday. It's basically the same exact game plan. Nothing's changed there. Yeah, so it's the same exact thing. Either a dip into 120.44 or a breach and retest of 122.60. Exactly what I said yesterday on a move here. So all we did in overnight trade was we actually retested 122.60 as resistance and pulled right back. You want to wait for a break of these purple fibs here. 121.40, 122.60. Same kind of region we need to clear. That's also the weekly opening range at this point. So objectively, if it breaks, you have a reasoning or it gives you a directional bias near term. Let's just say that. So preferably 22.60 gives out as resistance, and you get that pullback to get long. If we break down, dollar really surges a little bit more fervor. The downside move, 120.44 is like the last. There's really nothing, beyond that. Nice pivot in price, an 88.6 retracement, and last-ditch effort for a hold for the pound. But I'd be very mindful if we do break the weekly opening range lows of another spill lower. So with that said, I also just want to highlight that the ongoing divergence signal that we've been seeing still remains constant on a lot of different time frames, including the 2-hour. That you're looking at right now. Lower lows, lower lows. It's really just these 2 reference points here of the lower low that we made in extreme this week and last week. But even if you bring it into a 240-minute chart, you can see the same thing materializing. In fact, on that, it's smoothed out even more so that every subsequent low has been followed by subsequent high in the oscillator. So exhaustion marking both on the momentum signature and in price, which is just basically holding basic channel slope support. Really nothing fancy here. Okay, so again, I don't want to be the fool trying to call the turn, but looks like pound still remains vulnerable, in my humble opinion, for some chop here. Again, I'm not going to really get aggressive unless I see some exhaustion near 20.44 or a rally through 22.60. And keep in mind you have the BOE on tap tomorrow morning. Okay, not necessarily expecting to hold change anything. Expected to hold at 0.25%. The interest rate target. Even the asset purchases at $435 billion. Nothing is expected to change. You're going to get I don't really think you're going to get much of a reaction from tomorrow's BOE, just because there's a lot going on in Europe. You know, the triggering of Article 50 seems imminent. Also keep in mind, guys, as far as the euro, I didn't talk about that earlier, you have those Netherlands elections that are going on today as well, the whole parliament being voted on. So certainly, you know, keep in mind these election and political event risks are going to remain something that's going to be in focus moving forward. Nice little touches there too, actually. Okay, any questions on the pound? All right, that's number 3. Number 4 is Aussie dollar. An interesting one for today. So for the pound, one last thing, 121.40, 122.60, know it, watch for the break of that range, react to a break of that range, and we'll see if we can't get some exhaustion for some long entries inevitably. But near term, I think you can look for the bottom end of the range just heading into the U.S. trade session here as the dollar seems to have a little bit more room. Heading into the Aussie dollar, keep in mind that we do have Aussie data on tap later tonight with the Aussie employment report. Aussie employment's been kind of interesting as of late, but specifically heading into tonight, you're looking for a print of about 16,000. Here's what the expectations are for tonight. After a previous read of about 13.7 thousand, unemployment expected to hold at 5.7%. Again, the caveat that you've been seeing with Aussie, I think we went over this yesterday, is the dynamic that you're seeing most of the disparity in that a lot of the jobs are coming via part-time instead of full-time. So look for that breakdown, and as well keep your eye on the broader labor force participation rate. Not as big an issue as you've been having in the United States, but nonetheless something to pay attention to. So that hits the wires at 20:30 later tonight after the dust settles. Also keep in mind you got the BOJ. So for the Aussie in general, it's a big day. You got the FOMC knocking on one door, the BOJ knocking on the other. Obviously a big trade partner with Aussie, and then you also have the Aussie employment data. So keep an eye on that. Where the Aussie stands in the meantime, look, we're probing through near-term resistance right as we speak, 75.86. If you guys remember the report from earlier in the week, here's what Aussie looked like last night, but if you remember the report from earlier in the week, we talked about this resistance level even from the 13th. Here's what the update on the 13th looked like. Okay, here's where we look like on the rally, looking for that 75.85 to cap resistance with a bearish invalidation level at 75.16. Fast forward a day, we rallied right into that early in the week on Sunday. 75.86 held as resistance. We were talking about looking for short exposure from here. Bearish invalidation, still at 76.16. Fast forward again to last night's update, and here we are again with the pullback, finding some support at those previous swing lows. The 618 retracement is 75.30. Nice little key support zone. You're looking at this focus range right now. We're probing the upper bounds of it. Okay, I still like the basic trade idea, no change. As far as the swing trades are concerned, we're flat or break even with a stop at 76. So if it rallies through 76, guys, no harm, no foul. But the basic premise of the trade, in my humble opinion, still remains pretty good here. The fundamentals remain pretty good. If we plow through 76.16, I think it rallies pretty hard. You go for a monthly open, you go for the August high day close, if anything. But you're basically probing near-term resistance at this point still. Downside targets, as far as your key support, still remains at 74.35, 74.50. Nothing's changed on that front. So you're basically trying to gauge how high this rally or this recovery bounce is going to be in the Aussie. I happen to think you're looking for the same game plan, where this can spike lower, actually give us a move towards that 74.50, If the dollar just rips and then it rebounds a little bit more higher or bases off of this region, if the game plan with the dollar that we highlighted earlier works out, where the dollar moves higher than moves off, this might not make it that low. Another move back into 75.30 might prove corrective before it makes a little bit more of an assertive bounce. So for Aussie, the focal range remains 76 into 75.30. Okay, look for a break of this near-term range post FOMC to give you the tell on Aussie. With a preferred move lower, in my humble opinion, and again, that's dollar strength, guys. Recognize that if the Aussie dollar moves lower, that requires some dollar strength. So a candidate in a dollar strength story, a favored move would be here in Aussie. In the event of dollar weakness, obviously, especially if you're fading the initial move, the euro is still going to be the favored move on that front. Questions on Aussie dollar? Again, employment data out later tonight. Okay, number 5, dollar yen. Here's what the abomination looks like. So still holding a very clean and simple weekly opening range. I think of all of them, this is actually the simplest as far as kind of trying to visualize how you want to play it. Excuse me, looking at the dollar yen, obviously the daily chart, we talked about this yesterday. I don't want to go over it all over again, but again, the high that we made, just the bottom end of a key resistance zone that we've been highlighting from 115.52 to 116. Near-term support, really focusing on just that basic slope support we've been following off the lows from last year. So, a couple different things. I was looking at this earlier. Slope is still being respected. If we take a parallel just off the lows that we made from here last week, we're still sitting there right now. I don't want to keep that line there just to keep the chart clean for you. But I also wanted to highlight that the weekly opening range is intact as well, and that converges on the same level. So 1450 into 115 is the level 50 pip range that you want to clear. Ideally, I don't like doing this, but ideally, on a dollar yen move, you see a move into key support here. This is the kind of pivot, 1360, of which this thing's either going to recover and resume or going to be the breakdown signal for us to look for a much steeper correction down towards 111.45, maybe even the 111 handle. Okay, so that's the pivot. That's the impetus. That's everything matters for me at 113.60. You've got those pivot lows from last week. You've got slope support for the near-term ascent, and you've got a 50% retracement of the advance, all right there. So with the same respect, let me take a step back, guys. With the same respect, how do I want to approach FOMC? Well, same exact game plan that we talked about with the dollar. If you see the dollar surge, you get a rip on the release. 116 tag, a 115.90 tag, in my humble opinion, would still offer an opportunity to try to fade strength, looking for a move lower. Okay. On the flip side, again, if we get a break into this side, looking to see how the market reacts with the dollar price action. Okay. 113.60 being near-term bullish invalidation for the upslope we've been following. Guys, does that make sense on dollar yen? Anyone have any questions on that? Kind of willing to play this on both sides, to be quite honest, within the confines of this range. Either a spike back into this region for a short, especially now with slope up there, or if we drop into here, I don't really think I'd do anything. I'd be looking for a reaction at 113. If you see a strong up or a strong rebound, I'd be looking to buy that bounce while within the confines of this formation. If that kind of just bears through and just makes a straight drop through 113.60, you could see this thing fall apart pretty quick. Monthly open comes down here at 112.70, and like I said, key support doesn't even come into 111.45. This is a level we just missed on the decline in the opening ranges last month. So pretty big for dollar yen once we clean, out of this godforsaken range that we've been in since the start of the week. Any questions on dollar yen? Again, feel free to take a snapshot of this chart, guys, if you need it for FOMC, but none of the levels have changed from yesterday. Okay, we are getting through them. Making good time. Dollar yen holding the OR, my notes say. Watch for the break. Okay, dollar CAD will be next on tap, and we'll take a quick segue after dollar CAD, guys, to look at crude prices. Loving it, by the way. For those of you who've been trading crude, those levels have been holding very well. But first up on tap, here's dollar CAD. So the loonie, not really something I've been involved in at all this week, but I mean, 135.26 has continued to offer resistance as level we talked about last week, or someone actually in the webinar has highlighted it, an 88.6 retracement of the decline, but we've been looking at it as slope, former slope support, now resistance, and that again held on the pullback. So look, it's a messy trade on the daily chart. I really don't want to focus on it, and typically if I don't have a good daily or a good grasp on what's going on with the daily, I typically won't get involved or operate on an intraday basis. But in any event, the near-term picture actually looks cleaner. You guys know about this structure. I haven't touched a darn thing. We've been working with that same structure for over 3.5 weeks. The advance parallel of that same slope did catch the highs roughly, and you can see that the weekly opening range is pretty tight here too, 134.30 to 134, let's just call it 135 on the upslope here. And you're looking for a downside break, noting that we've been looking for exhaustion here as divergence marked into the highs. Looking for a pullback. Ideally, a 133 clip would get me really excited. 133.18. The monthly open comes in just lower at the 133 handle. A snap into this region is sort of what I'm looking for. As far as near term, that's my favorite move. I don't really want to target anything sub 133. I don't necessarily think that'll cap the decline, but that's what my target would be. Sub 132.50, I think, is where you look on full-on reversal. I don't know if we'll necessarily get that. In fact, I think this might be a great long opportunity, but in any event, I digress. The focus near term is on this consolidation. Now, a lot of times, these consolidations, triangle patterns, can be terminal. You had one right here that resolved itself on Friday, broke through, and pulled back. So was that it? Is that the last gasp? Well, now you're getting another consolidation pattern right here. Okay? Could be one last gasp again into resistance before pulling back. It'll be interesting to see how dollar CAD reacts, to be quite frank with you guys. I don't really have sort of my focus on this heading into the release, but key levels to keep in mind, still 35.26, no change. Near-term support 34, and like I said, 33.18, 33 would be a gift if we do get a downside break. I would be willing to participate in shorts sub 34 into that 33 handle, because I think you have a clean out here. If this starts to really break the median line and starts to break the range lows from Friday, where you saw strong support on that data print, remember, CAD data was exceptionally strong, as well as dollar data, but you saw this thing, despite that decline, really hold on a strong rebound. You had a nice 30, what was it, like a 50 pip, 60 pip bounce right off that support. So just tells you where the market is positioned, right? So if we do break sub 34, I do think that there's fair play here for that 100 pip drop to be played on the short side for dollar CAD. Any questions on the loonie? With this picture in mind, okay, that was number 6. Take a quick segue here to crude prices, which have been making headlines as well. Okay, here's what crude prices look like on the near term. I mean, this thing is just sick clean. Here's what it looks like on the daily chart first. A basic 618 retracement, and I noted this yesterday in the report, 47.16, a basic 618 retracement of the advance off the lows that you made from the November rally. So this is post-election, the ripperoo. We'll look at risk assets in a moment. Same rally that you saw over in the SPX, right? 618, 47.16, almost a perfect tag as support yesterday, and then we ended up closing higher on the session. Pay attention to those things, okay? Especially on the back of a 6 or 7 of a 6-day consecutive decline. you spike into a new low of a Fibonacci relationship and close higher, bucking a 6-day decline trend. That's something to pay attention to. Now, it's not go, long, close your eyes and hope for the best. No. There still can be back and forth. You could still go for a retest of that, but the broader focus in price action here is for exhaustion. And certainly momentum is still in oversold territory, so the propensity for this thing to keep going is still there. Not going to call a low on it, but I am going to say above 47.16 at this point. You want to be mindful of short exposure. 48.70 break to the upside is what I want to see. 48.75 break to the upside, or not even. No, it's 48.70 exactly. I'm sorry, is what I want to see to get this thing going. You got the 200-day moving average, which for the last 3 days has been offering resistance, including overnight, and you got the 50% retracement of that range. So once we get through that, I think you look for a little bit more of a stern recovery, and again, crude recovery, that's CAD strength. That's going to help our efforts to drive dollar CAD lower, if we get it. And if we do, it's a near-term recovery. Obviously, the spill that we got in the break of the yearly opening range does suggest you have more downside in crude. Near term, the propensity for a little bit of a recovery is there. Okay, and on that front, here's what the intraday chart looks like. Even looking within the confines of the decline just off the highs, you have some nice slope, lower parallel, catching those lows. Again, if you take some slope, whoops, I did not mean to do that. Yeah, I did not mean to do that. Okay, hold on one sec, guys. Sorry about that. If you take a parallel off of this slope, is what I was trying to do, you can see again that broadly holding those lows, 618 retracement of the advance, as we just looked at in the daily chart, gives us a little bit more of a risk for a bounce to the upside here. Throw that 50 line on there, got a nice divider. That's now near-term resistance. Okay, topside break, and you're going to work with a basic retracement off the lows. That's what I was looking for. Okay, so your first target, I'd want to actually stretch it to this low. Now I'd give you these targets here. Really, just the first level would be 49.60 followed by 50. 50 is a pretty big pivot in price. Depending on where you are in time, that'll also converge and mess with the median line region here. So based on where we are, guys, on the breakout in time, these are both regions of resistance of which I would look for near-term exhaustion. I would look for possible short entries on an intraday play here for crude. But broadly, I'm looking, the focus for me is on a break above 48.70 near term to really validate more of a corrective bounce. Interim support right here at what are those former range lows? 47.90. Oh, that's what that 618 was. Sorry about that. Bear with me one sec, guys. Same level. 47.90, let's call it. Boom. So those levels are for crude. And based on price action yesterday, as we noted, sort of works pretty well with what we're looking at over on dollar CAD. Hey, John, I just read your email this morning. Actually, it was forwarded to me by the intern. I just read it this morning. I was going to respond to you. No, I got you. You can always ask anything in the room here. As far as the SB swing trade, so this report, Jamie's report, gets published each day after the market close with the orders, and those are good for 24 hours. Execution of when the order actually hits, John, we don't have an alert on that yet. We are releasing, and I know this has been a little bit delayed, guys, but the tech guys are working on it right now. We are going to be releasing the SB signals soon. That's going to be at no added charge. Obviously, it's going to be for everyone here who's a subscriber, where you can subscribe and you'll get email alerts for signals on active setups that we're trading. But they're all algorithmically being processed. Basically, it's an RSI momentum system that we have set up. We give you the bias, and it's going to shoot out when the conditions are met of which we want to operate on. Jamie's going to do a whole webinar on that, guys, to really set you up before we roll it out so that everyone's ready to go and knows how to use that effectively. And we will be updating you that as the info comes through. But John, as far as the pending orders, you just need to make sure that report, just make sure you view it. We tweet it on SB Squawk as soon as it's published, right after the market close. And again, those orders are good for 24 hours. All right, the next day's report will always show you what trades are pending, open, so you'll have an idea of kind of what's still on the table. Okay, so John, hope that answers your question. Let me know if I missed anything or there's something specific you have a question on. So that's dollar CAD and crude. Near-term focus 48 into 48.70. That's the range I want to see break, favoring a more prominent topside recovery, of which we would ultimately look to sell a little bit higher near 49.60 on the near-term approach. All right, moving right along. That was Aussie dollar. What was next? Dollar yen we went over. Dollar CAD we went over. Kiwi. My least favorite, I'm going to leave it at the very bottom of, of the list from yesterday, but look, the levels are clear, and as I always promise, when the levels are clear, I got to relay them, even if the trade necessarily isn't my favorite. And the only reason I don't like this is because I do think, as I said yesterday, and it's materializing, obviously I'm not in the trade, but my gut feeling is for a move higher here to sell. It doesn't really work in line as aggressively with sort of the broader dollar theme here. But look, 65 or 69.15 to 69.70. We talked about this region for a while. Friday didn't really show much of a bounce of support, so I'm not necessarily looking for this pivot to be very strong, except for the fact that the median line sails through here now. So if we do pop higher, we could get as high as 70.30, 70.45 again, and that's a level I'd be interested in selling. And that's a little bit of ways we are from where we are right now, considering for the last 3 days this thing hasn't done jack, but that's sort of the game plan. And at this point, even if you take a basic simple retracement, now that we're looking through on a probe, if we do break that, look what it highlights. Topside break gives you 70 handle, right at the 70 handle. The region we're looking at is 70.36, 70.45. The 50% comes in a really interesting pivot in price here. If you look to the left, boom, support, resistance, support. So, I mean, 69.70, watch for a break above that. If you get a break above 69.70, I'm not necessarily saying I'd want to be on the long side, but I'd be looking for a stretch to possibly look on a fade opportunity near 70.35, 70.45. The thing I like best about this setup, guys, is the slope. It's been really, really, really clean, despite the median line not really, doing much up here. Look at this on the near-term approach. This is the 618 line, or this is the 75% line. Resistance, resistance, support. The break fueled the downside move. Even the median line support. It didn't last very long, but as soon as we broke it, it was instant resistance. That's what you want to see. And here we are again. So the weekly opening range on its face value has taken shape below resistance. That's all I wanted to highlight. If you see the topside break, sure. Look for that move towards 70.35, 70.45. That's a little bit more of a critical region of which I'd be looking for resistance. A downside break of the weekly opening range, you're looking for 68.60. You're looking for 68.30, and then there's lots of room for a drop into 67.50, in my humble opinion, if we finally clear this low here. So look for a break of this range on FOMC. Broader bearish invalidation will keep steady at 70.45, that high that we talked about. Any questions on Kiwi? No Kiwi data of material importance that we need to really pay attention to. We do have GDP figures for the fourth quarter tonight. I stand corrected. That comes out at 17.45, 0.7%. We are expecting a little softening of approach quarter on quarter, but really the year-on-year figure is supposed to slip to 3.2 from 3.5%. This is the expected read already, guys. So we are already expecting the weakness. If it comes at or in line with expectations at 0.7 and 3.2, and that don't necessarily think that'll be a market mover, but a softer than expected print may give us the fuel that we're looking for a downside move. Here's the 30-minute looks like. Let me just see what this looks like near term. Yeah, momentum's still pretty constructive. Knocking on the door for 70 here. No divergence just yet. Wouldn't want to try to fade it, but you are entering into a near-term resistance zone. I'd be surprised, to be quite frank with you guys, if this thing breaks through on FOMC. So heading into the release, you still have, 4 hours, 5 hours before Yellen. I'm still looking for exhaustion within the confines of this 20-pip range to the upside. Okay, that's Kiwi. Mike, to be clear, preferred pairs for U.S. dollar strength, weakness on FOMC. Graham, so that's the last dollar cross, so you asked at a good time. So to recap, on dollar strength, I would say Kiwi and Aussie would probably be my favorite plays. On a dollar strength story here, for sure. A move lower off resistance would be a nice play, targeting 68.60. In Aussie dollar, specifically on a failure to break through this material resistance into 75.86. Remember, I still have my personal bearish invalidation around 76.15. I know Jamie has the stop for the swing trades at 76. We're basically talking about 15 pip split here, but yeah, if you see a spike and the dollar rallies Aussie short, I still like it. Same thing with the Kiwi, right, Graham? On dollar weakness, I would have to say my favorite move, and that's really what we're looking for, right? To fade dollar strength. So if dollar makes a new high, I'd like to fade it. That's dollar weakness. My favorite play would have to be euro and sterling, more so sterling even. Not necessarily because I'm trying to call a low on this again, but because it's such a crowded trade, everyone's looking lower. I think even if euro does rally, that'll kind of give us some lift here in the pound as well. So I think those are the two I'd favor in the account of dollar weakness. Graham likes that pound trade, huh? Yeah, me too. Dollar yen is going to be a variable for me. I really, honestly, dollar yen, I'm not going to be looking at the broader dollar story because this thing could buck the trend either way. Dollar yen, I'm strictly price action and always will be. I don't think there's any point in trying to get cute with this one. So it's either a drop into 113.60, great. Let's look for a possible long opportunity. Interim support would be right here at 14 if that holds, 14.30. If we just rip into 116, I'd be looking for a fade. That's it. That's it. Try to play the breakout, by the way, if it breaks through 115 on a rally. Try to play the breakout from 115.10 to 115.90.16 would be a kind of aggressive attempt in my humble opinion. If that happens, it's likely to be pretty quick. You don't want to get caught chasing on Yellen, guys, because it's commentary. So she could say one word that moves the market 30 pips in one direction. You jump in late. She tries to correct, or all of a sudden she backwalks it or sidesteps it. Now all of a sudden the market can come right back. So don't get chopped up. Wait for the dust to settle. and you have our game plan. You kind of have the levels that we're looking for. Play the levels. Okay, let's take a quick segue into the commodities. If you guys have any questions, do let me know. You're more than welcome, Graham. A quick look at what we're looking at with the com block. Here's gold. I just wanted to highlight this key support again that we've been following at 1193, 1200. Nice little butter zone that we've been sitting in since last week. You have slope support and the median line sitting right in there as well. And that's really the level to beat. With a drop lower from there, eyeing 1176, 1180, an area of interest for long entries for us from our part, and for exhaustion on a rebound here in gold. That said, you're at support right now. Okay, so if it does break, dollar rallies, might be a nice drop of which you'd look for entries. Again, one last gasp in the dollar, possible recovery, or pullback rather, in the greenback would give us a nice recovery here in gold. If we top 1211, basically the highs that we made for the opening range for the week, you're in for a steeper recovery here. Here's what the intraday chart looks like. In such a scenario, you're basically looking for a rally up towards 112.16 into 112.20, this region up here, both from a slope standpoint and from a basic Fibonacci standpoint. Here's a 4-hour. Okay, and again, you're seeing some consolidation here on the near term. Guess this is going to be more apparent if you take it into like a 60-minute chart. You can see the consolidation that you've been seeing heading into the FOMC. It's kind of a beautiful play there. So you could envision a scenario, guys. And again, I hate kind of just walking you through what I hope and think will happen, but just you can envision a scenario where, again, you get a terminal break to the downside, goes for a clip of 1180, and then you see that rally again rip through. Or if it breaks through, like I said, 1222, topside break of the opening range, highs for the week, would certainly shift the focus back to the upside towards that 1220 region. Oh, keep in mind your weekly open is here too. Wow. Doesn't mean to get much closer than that. Questions on gold. A lot of people are going to be talking about bullion prices today, guys. And again, the interest rate outlook is important for gold. One of the classic functions of gold, besides being a store of wealth during times when markets are in disarray or distress, it's also a hedge against inflationary pressures. So we got those CPI numbers today. Looking at the outlook and the inflationary outlook from the Fed in the projections will certainly impact the outlook for gold moving forward. Okay, that's number 9. Quick segue into silver. Here's silver. Time kind of snuck up on us here. Here's what the silver trade looks like on the intraday. On all these commodities, guys, the intraday chart is where all the sexiness, let's just call it that. All of the clarity for me is on the intraday charts. I just wanted to highlight, here's the daily chart that we've been following in silver. Again, you're kind of probing right now and messing with the lower parallel. The 618 doesn't come in till lower at 1672, but if you look at the intraday chart, it's still pretty clean. Here's the 4-hour. Okay, and you're just holding the lower parallel. This is also the range lows for last week, 1680. Again, 1670 is the actual 618 retracement. So, you could see another drop into this region. I wouldn't be too surprised. To get bullish or to continue to respect resumption of the uptrend we've been following off of the lows from December, you need to clear 1740, 1738. This region right here. That would be a nice clean rebound back above the lower 50 line here, the 38.2 retracement. In fact, there's some confluence if you throw on a near-term retracement just of this decline. I didn't want to throw it on there because we haven't, we don't have conviction of this being a low yet, but you can see that at 38.2, even if that highlights 1745, 1740, key region. Once we get through that, I think you're looking resumption. And if the dollar does correct lower, that's going to be, for me, the play to look for targets back at 18.35. But near term, you know, a clip sub 1670, and I do think this does fall apart. Okay, 1655, 1620 would be subsequent trades. By my part, a favored move would be a rebound continuation higher. And you're marking divergence into those lows, right? A decent divergence signal in that the fact that price action made a lower low on a close and the reference points one below 30, one above, does suggest that the downside momentum is waning as well. Okay, so testing the bottom end of key structural support for a multi-month formation in silver prices. Just wanted to highlight this 1670 into 1680 key support zone. Moving into copper, number 11. Here's what copper looks like. A little bit more of a cleaner formation in that we're coming off of strong downslope support. This is a 618 line of the descending formation off the highs. You saw that catch the low here. Here's your weekly open. Tight weekly opening range. I'd be remiss to call this a opening range break because it's kind of only gave us Monday's range before breaking. But what I wanted to highlight was critical resistance here in copper near term. You're basically looking at like 267, 268, a basic 38.2 of the ascent. This is also an exact 100% extension. So if this is just corrective, that's your extension. Former slope support. Now resistance comes in just higher, like 268, almost 269. So long story short, look for this stretch to look for a reaction here. If this does hold as resistance on a dollar strength story, I do like this moving lower. But if the dollar comes off and falls apart more abruptly, this is your breakout zone. A breach above this, you got really nice targets up at 272, and that would be a 618. Okay, what would put me back on the bearish side, or the bearish camp, let's call it, in copper? It would need to be a break sub 261. That region there, I think, would flip things back to the short side. So those are the levels I'd be looking at for copper. Feel free to take a snapshot of this chart if you need that for future reference. SPX, I do want to just touch base on that. I'm not sure who asked about that yesterday, but I didn't get a chance to review it. It's not something I typically trade on an intraday basis, but it does look interesting at these levels. You know, here's the broader daily chart looks like. Jamie's got a better grasp on this than I do, guys. He follows risk assets a little bit closer than I do. All I wanted to note is that the divergence, the momentum signature breakdown that we're seeing, with momentum coming back below the 70 marker. Really, I just wanted to also highlight this zone. Just a big confluence region of trend lines. Basic trend line resistance, which offered a very nice pivot break. In purple, this is basic trend line support. Take a parallel. Really nice. Same slope break. That converges. This is the formation we've been following off the 2015 and 2016 lows. The 50 line also converges here. So it gives you room for a downside push towards 2345, 2350 is what I'm trying to say. On the intraday, a little bit more interesting. Okay, just some levels of consideration. Again, as a disclaimer, I do not trade this personally on an intraday basis, and the reason for that, guys, is because there's really no reason to try to get cute shorting the risk assets since the election. I mean, since Donald Trump got elected right here, even on an intraday basis, trying to get short on this has just been a fool's errand, right? You might as well just take all the long exposure on every decent pullback in price. So until we get some sort of technical turnaround, which we haven't gotten yet, I'm not really interested in trying to intraday trade this. That being said, 2383 is a key near-term level of resistance I'd be looking at. It's also, it is based on a near-term extension off the low, retracement off the high, near-term price, just taking into account this month's price action. So that's a key region that you need to respect at 2380, followed by 2398, and that's sort of your breakout level for further resumption of the upside trade here in the SPX. As far as interim support, 2350, okay? the upper end of that zone that we just highlighted on the daily chart into 2330, sort of a key zone, both key levels on the intraday basis to watch. Okay, you have slope, last week's range lows, and below that, an extension from the decline off the high takes you into 2330. Okay, so just levels to keep in mind heading into the FOMC on a strong reaction if we do clear this near-term consolidation range in the SPX. Okay, I'm talking a million miles per minute, but we're going to get through to nat gas. I promised you nat gas, and here it comes up, Vlad. Here's what nat gas looks like. I think we did an update on this yesterday, so we shouldn't be too far off market. Okay, nice. So we got that breakdown. We did turn at former channel resistance, now support, yeah, just ahead of that. So our target was 284 on that decline. Didn't quite get that. Look, I think you could still get a move back. Former support, offer some resistance on this, Vlad, before you make that drop into 284. At this point, I would bring down bearish invalidation to the weekly open. 304, the weekly open, this region here, 3 into 304. Give me a 4-cent barrier here as near-term resistance and bearish invalidation. I mean, look, it was a break of the initial weekly open. I still think that you could test that former trendline support as resistance, but 284 still seems like it's doable. Let me take a real quick look at this extension off the highs, see if that completed anything. Okay. Watch that zone. And we're getting real granular here, but I just want to see what this looks like. I don't suspect it'll yield too much, but I just want to see if we have... Might be worth keeping an eye on, just for the near-term prospect. Continues to highlight the downside slope at 284, so actually might want to just leave that on there. All right, does that help, Vlad, on nat gas? That's what I'd be looking at as far as near-term levels are concerned. I don't necessarily want to say that, you know, I would have to say it's still a break in my opinion. Classic basic technical analysis, break as support, test it back as resistance before it turns over. Momentum hasn't broken through 70 yet. Since the 70 break, we broke below 30, and here's a turn ahead of 70. I mean, it's classic break, retest, and follow through. So I think we're still on pat for 284 in my humble opinion. 286. All right. He says yes. All right, cool. All right, guys, I'm over on time. I wish everyone luck. If you're concerned about today, that's fine. That means you're human. It's going to be a fun time, but also it's a time of which we want to exercise a little bit more caution. Watch the presser and let the market filter through what she said. It's the first time we're getting these new projections, so we are going to be digesting sort of a new mode of transparency, a new mode of communication, let's call it, from the Fed as far as the dot plot is concerned. Again, I'll keep you updated on SB Squawk. Best of luck trading. We'll see you tomorrow morning. Cheers.